Hello and welcome back to the channel. I hope you're doing well. In today's video, I'm going to break down a vertical spread trade. And what that is selling a call or selling an option to take advantage of time instead of have it go against you. You're going to sell something and hope that over time, the value of that option goes down, whether the price chart actually works for you or something called theta decay or time decay, and you're actually going to make money off of that. So it's a great way to make income and boost your account and do it a little more in a controlled manner and have a lot higher probability. So if that's something that interests you, stick around. I'm going to show it for you right now. So BABA is found itself outside of the Bollinger Band. What's a Bollinger Band? That's the blue line I have here on my chart. And so the Bollinger Band is essentially just showing you two standard deviations. And when a stock goes beyond two standard deviations, it typically wants to find itself back inside the range. So we see here is a perfect example. BABA got out of the Bollinger Band and it ended up coming back in. It gets out of the Bollinger Band here and it wants to come back in. It gets out of the Bollinger Band here, comes back in. And then one more for good measure, gets super overextended here, which is what it looks like right now. And what did it do? It wanted to come back into the Bollinger Band. Now, it doesn't mean that it's going to happen every single time. Sometimes it can extend out like this and then just mull like that. And then the Bollinger Band can continue up and all this stuff. But typically, when it ends up getting out over the Bollinger Band, it wants to come back in. And that's actually, I believe, 90% of the time. Price finds itself within the range of the Bollinger Band. So if I know, okay, 90% of the time, price finds itself within the Bollinger Band, that means when it gets outside of it, more often than not, it's going to find its way in. So I can take advantage of that by selling a call. Now, because I'm selling a call because it's high up, and because it's gone up above the Bollinger Band here, so I'm thinking that it might peter back down here and find itself in the range. Because it's going to go down, I want to sell a call. If I was going to buy a call, I would want the chart to go up. And so if I sell a call, it's going to take advantage of it going down, right? So if we look at an actual mechanics behind a vertical spread, you're selling an option that's closer to the money. So right now the stock's at 106. So you're selling an option, so it's more expensive. Right now, this option costs $3.12. This is going to expire January 20th, so only a couple weeks from now. Not even. So you're selling at $3.12, and then you're buying an option at $1.78. Now, I did this yesterday, so I sold at $2.96, and I bought at $1.77. That means that I actually have a credit of $1.19. So $1.19 is what I get paid. Now, I got three of them. You can see here I had three of them. So I essentially got paid $357 credit for this trade because I sold an option that was more expensive than the option that I bought. So I have the potential to make $357 on this trade. Now, I'm taking advantage of something that I'm hoping the option becomes worth less. So it's like shorting a stock. You want to see a cool video on that with a great analogy you'll understand right away? Check out this video. So on the blue line here, my potential profit is 357, and it starts to go down as the stock gets over 111 and change. So that's signified by the red mark here. So if I go to today's price, if it gets down and goes up above that and I say, okay, this is too much, I need to get out, I'm going to lose $268, signified right here. But watch as time goes on. It actually starts to get less and less and less. So as I get closer to expiration, time is on my side and I actually end up losing less if it ends up cracking over that. So it's a really great advantage because if I bought a call, I need this chart to just continue ripping, and it's already gone on like 4 days of just having great time, right? I need it to continue going or I'm going to lose. If it goes like this and goes sideways, I'm going to lose value. If it goes down like this, I'm going to lose. And if it cranks down all the way, I'm obviously going to lose. Whereas with this, selling an option, It can stay here. It could even get up to 111 and then just kind of peter around there for a bit and come down. It can go sideways and chop around. It can come all the way down here, or it can just crash and I'm going to be making money. There's 3 or 4 ways that the trade's going to work out for me when I sell the option, and there's only one way it's going to work out for me if I buy a call. So hopefully that kind of explains why you would want to sell options rather than buy them in most scenarios, quite honestly. And hopefully this kind of makes it a little simpler for you. If you have some questions, just comment below and I can do a video. I'm going to do more videos like this because these are great ways to pad your income and have your account grow slowly over time, and it's a lot less stress-free because I'm just taking advantage of probabilities. So I hope this made it a little more simple for you. Thanks for coming by. Have a great day, and I'll catch you on the next one.